Welcome to Fireside Chat. My name is Sai. If you're new to my channel, I talk about how I budget, save, and invest money to achieve financial independence. In one of my previous videos, I talked about how my fiance and I plan to prioritize our savings and investment to achieve financial independence and retire early. In one of the steps, I mentioned that we have a taxable brokerage account with Charles Schwab that is dedicated for dividend investment only. Our goal is to invest at least $1 million into that dividend stock portfolio that can generate anywhere between $30,000 to $40,000 in dividends. This will eventually become one of our passive income streams, because I truly believe that investing in dividend stocks is the easiest path for anyone to create passive income. So in this video, I'm going to talk about how we plan to achieve financial independence with our dividend stock portfolio and how to choose individual dividend stocks that we plan to hold for at least 10 or more years. Here's my quick disclaimer. Since this video is about individual stocks, I am not a financial advisor. Just because I own these individual stocks, it doesn't mean that you should too. So please do your own research before you decide to buy any individual stocks, ETFs, or mutual funds. By the way, if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session. You can fill out the introductory form by clicking the link in the description below. Our F.I.R.E number is $2.8 million or $100,000 a year. We can achieve lean F.I.R.E if we invest at least $1 million into our dividend stock portfolio that pays anywhere between 3 to 4% in dividend yield. If you are brand new to dividend stock investing, you can check out the 3-minute video I posted on Saturday, and I will post the link now. If we have $1 million invested into the dividend stock portfolio, and let's assume that it's going to pay about 3 to 4% in dividend yield, that should be about $30,000 to $40,000 in passive income just from dividend payments. Having $40,000 in passive income, you can really live on that, because that can pay our housing, utilities, groceries, insurances, and any out-of-pocket medical costs, and that's why we call that achieving the lean F.I.R.E. There's also a tax advantage in holding dividend stocks. When we retire, if our taxable income is less than $80,000 a year, and that's if we file our taxes jointly, the tax rate on qualified dividends is 0%. That would be tax-free on the qualified dividend distributions. We could save a lot of money on taxes if we do it right. Keep in mind, this is based on the 2021 qualified dividend tax brackets, so if you decide to do this, make sure you contact your CPA. You should also be aware that President Biden and the Democratic Congress recently proposed to raise capital gains and the qualified dividends tax brackets, so we'll see what happens to our tax brackets by the time we achieve financial independence. Now let's talk about how dividend reinvestment works. I have been dollar cost averaging my investment by every 2 weeks into my portfolio. My average dividend yield for this portfolio is about 3.5% with 5 individual stocks, and it has gained a total of 17% with dividend reinvestment. In year 1, let's say I invest $12,000 into the dividend stocks with 3.5% dividend yield. At the end of the year, I should have about $420 in dividend payment. That's a total of $12,420, not counting the capital gains. Again, these are just rough estimates. In year 2, I invest another $12,000 into the portfolio, and that's $24,420 by the end of the year. If the dividend yield stays the same at 3.5%, then that's another $854 in dividend payment. That's a total of $25,274. You see how these numbers keep going up if I keep reinvesting my dividends into these stocks or buy different stocks. If you invest into great companies, they should keep raising dividend payments every single year. That's why you want to find a stock that is considered sustainable, low risk, and have room to grow. So how do I pick the right dividend stocks? So just because a company pays you over 4%, 7%, 10% in dividend yield, it doesn't mean that company is the right one for you. It might not be sustainable, and I will explain that at the end of this video. There are companies that are considered dividend aristocrats or dividend kings. A dividend aristocrat is a company that has been paying and increasing dividend payments for 25 consecutive years. A dividend king is a company that has been paying dividend and raising dividends for 50 consecutive years. However, when I buy a dividend stock, I don't necessarily buy a stock that is categorized as a dividend aristocrat or a dividend king. I like to find stocks that have been beaten down 20, 30, 50% in the last year and that pays higher dividend yield and have a lot more room to grow in the future. So let's look at Walgreens Boots Alliance for example. The trailing PE is 19 and the forward PE is less than 10, and so that makes the stock really cheap. The stock price is currently at about $49.62 and the dividend yield is at 3.85% as of September 19, 2021. I bought this stock at $36 over a year ago because I thought the company was extremely undervalued. The PE ratio at the time I believe was 6 or 7. This is the stock that has been paying and raising dividends in the last 46 years, which makes them the dividend aristocrat, and they're 4 years shy of becoming a dividend king. I'm sure you have heard of Walgreens before, but just in case you have been living under a rock for quite some time, Walgreens is a global leader in retail pharmacy, dispensing medicines in over 25 countries and employing over 450,000 people and has 21,000 stores worldwide. Their main competitor is CVS Pharmacy. This stock has given me over 30% in total return since last September, and I believe this company at $43 billion market cap will eventually double or triple, and I would say probably in the next 5 years. Now this is my bullish thesis on Walgreens Boots Alliance. You see how I'm not just focusing on the dividend yield, just looking at Yahoo Finance. Here are some other things you should consider when you're picking a dividend stock. You should look at its stock performance, payout ratio, dividend payment history, and the dividend growth. Walgreens stock price has been beaten down by 39% in the past 5 years. However, it's performed 33% gain in the last year. Walgreens announced in July that they're increasing their quarterly dividend by 2.1%. That raised the annual dividend rate from $1.87 per share to $1.91 per share. The dividend payout ratio is 72%. So imagine if I find another undervalued stock like Walgreens Boots Alliance and say I find 5 more, 10 more. Well, if you hit the subscribe button and the notification bell, my next video is going to be about my 5 individual dividend stocks that I'm currently holding and buying. Another thing is when I research a stock, I always go to their investor relations website. So if you're interested in buying a Apple stock or Tesla stock or whatever, you can Google and type in Apple Investor Relations, or you can type in Tesla Investor Relations. That's where you can find their financial reports, quarterly reports, and annual reports. You can listen in to their conference calls, and you can actually read their presentations on what their future growth is looking like for the next year or so. And something else to keep in mind, and I've mentioned this briefly before, but when you buy an individual stock, just because it pays you 4% dividend yield, it doesn't mean it's a good stock to buy. You should also look at the company's dividend payout ratio to see if it's high. And what's considered high is anywhere between 70 to maybe 95%. That's very high because it implies that the company is paying the majority of their earnings to their shareholders instead of reinvesting into their business. There are also companies that pay over 100% in dividend payout ratio, and that's not very sustainable because the company is probably borrowing money or doing something else to make those dividend payments to their shareholders. So the chances are they're probably going to cut the dividend payments next time, or they're going to cut it all together. Bottom line is you should always look at the company's financial chart to see if they're making healthy dividend payout ratio. So I would say anywhere between 30 to maybe 60% is considered healthy. If you don't want to do any research on individual stocks, you can always go with a high dividend ETF that tracks over 400 companies. In one of my retirement accounts, I actually invest in Vanguard High Dividend Yield ETF, ticker symbol VYM, which tracks over 400 companies with an expense ratio at 0.06%. Its top holdings are JP Morgan Chase, Johnson & Johnson, Home Depot, Procter & Gamble, Pfizer, and Verizon. Most people like to hold dividend stocks or ETFs in their retirement accounts, so they don't have to pay taxes on the dividend payments. VYM in the last year has performed 32% in return, 10% in 3 years, 11% in 5 years, and 13% in the last 10 years. It has slightly underperformed the S&P 500 index. The dividend yield for this is 2.7%. Thank you so much for watching my video. Let me know in the comment section down below what your thoughts are on the dividend stocks. If you need help with your personal finances, you can contact me by filling out the introductory form, and I will post a link in the description below. Don't forget to check out these 2 F.I.R.E videos and my Instagram page. I will post a new F.I.R.E video every Saturday and Sunday at 9 a.m. I hope to see you in the next video. Have a good one. Thanks for watching. Don't forget to hit the like button and subscribe for more F.I.R.E videos.